I'm joined by Matt Lewis, who's Vice President, Head of Implementation and Capital Markets at American Century Investments. Matt, thanks for joining me.
Thank you, Todd. Good to be here.
It's great to have you. So we're going to talk about how to get the most out of ETF trades. What we've seen as we've jumped onto the next slide is that the ETF industry had a tremendous year in 2021, record inflows of over $900 billion, according to our data. That was nearly double what we saw in all of 2020. The heavy lifting took place in the equity markets. You can see here nearly $700 billion of new money flowed in, and a slight record of just over $200 billion flowed into fixed income ETFs. We hit the record in July. We did not slow down. And even though we've seen a choppy market to start 2022, investors continue to move towards ETFs. We'll move to the next slide here to just talk about how ETFs have historically been thought of as index-based products, tracking the S&P 500, the Russell 1000, the NASDAQ 100, and so forth. But we've actually seen a strong showing for actively managed ETFs, those that have discretion in choosing individual stocks or bonds. As you can see here, they gathered about 1 in every $10 of new money that came in 2021, despite being just 4% of the overall asset base. So punching above their weight at 10% of the overall flows. And then lastly, another slide I want to show, we'll move forward one, is just the number of products that have come to market in the last couple of years. We saw over 450 new products in 2021. That was greater than what we saw in 2019 and 2018 combined. That's based on ETFs that are currently trading. And we see the step ladder, as you can see, of ETFs that continue to move forward, both actively managed, index-based, a combination of those that are more factor-oriented products that have come to market. And as we'll get to on an upcoming slide that Matt has, many of these products are not yet fully formed. They're still gathering assets, and investors need to fully understand that they can trade these ETFs before they hit a certain milestone. I'm going to have one more slide on the next one, if I can, that just reminds the audience about how we at CFRA are researching and rating ETFs. We take a more holdings-based approach. We look inside the portfolio at the risk and reward characteristics of the portfolio. But what we also do that's relevant to this part of the conversation is look at the total cost, not just the expense ratio, but the price to net asset value, premium, or discount. We're going to talk to you about what that is and how that's important to you as you're making trades. But we're trying to help identify what ETFs look strong going forward. So just because an ETF has less than 3 years of history, just because it trades less than 100,000 shares on a daily basis, doesn't make it a bad ETF or a good ETF. You need to do your homework, and you need to have the tools to be able to do that and the partners to help you do that. So that's why I'm excited that Matt's here to talk from American Century's perspective about how to think about ETF trading instead of just looking at what's on the screen. So let's move forward one more slide. I'll hand it over to Matt, and I'll be back in some additional questions. Matt, before we go in, I just want to remind the audience that they can submit questions for you and I to try to answer in the Q&A chat box that they see on the screen. And there is a PDF version of this slide presentation, so they don't have to scribble to keep up with all of our comments. Matt, now let me turn it back over to you formally.
Great, thank you, Todd, again. Great to be here, and thank you all who have attended this webinar. Excited to talk to you a little bit about ETF trading. Very important topic for all of you that are out there, just to ensure that you're taking some simple steps here to get the most efficient trade that you can when you're going to implement the strategy that you want to invest in. Before I begin, though, I'd like to talk about, capital markets. Like, what is it? And, as head of capital markets for American Century, I like to think about it as having 3 distinct and key roles within the overall ETF business that we have here. One is that we have very deep relationships. Me and my team have very deep relationships with the capital markets participants. That's authorized participants and market makers. And they are the ones that are making markets for your products that you want to invest in, our products that you want to invest in out there. And another role that we play is that we monitor our products for their market quality. And when I talk about market quality, I talk about spreads, volumes, and premium discounts, some of the things that Todd mentioned. And If we see something that might be out of line with our expectations, we'll work with the market participants to have an understanding why and see if there's opportunities to bring it back in. It could just be an anomaly for that particular day or that particular minute of the day that causes maybe a spread to be wider than what we expect. Another role is that we work very closely with our clients and our sales team to guide clients through the ETF capital markets ecosystem. Ensure that they are taking these simple steps that I'm going to be talking about and educating them and giving them guidance when they're going out to implement their models or trading strategies or investments that they want to participate in through the ETF structure. So with that, let's move to the next slide. This is a visual that I like to put up at the start here. What this is showing is that there's a lot of ETFs out there, and with that there's a lot of ETFs that look like that they're not liquid, meaning that they don't have a lot of volume, but that's far from the truth. And this is becoming less and less, but in the past, investors have scanned ETFs based upon volumes, premiums, discounts, and so forth, and leaving a lot of ETFs out there off the table to be able to use to implement investment goals, strategies, and so forth. Because as this chart sees, 90% of the volume of ETFs across the whole industry is just made up of a small amount of funds. And the rest of them are under, say, 1 million shares a day. But that doesn't mean that they're not liquid. They are definitely liquid. There's just ways to access the market to get the most efficient trade for those. So we can move forward. Also, there's going to be some 4 key participants I talk about throughout this presentation. I just like to spend some time to define what they are. Authorized participants, as you may know, and what you hear out there is that, and which the articles say, is that authorized participants are the ones that make markets in our products. Although that could be true, really an authorized participant is the sole role of an authorized participant is to be able to create and redeem shares of the ETF. They have access to be able to do that. Who's really making the markets are the ETF market makers. Now, ETF market makers could also be an authorized participant, but at the time that they're making markets, quoting the ETF, they're considered an ETF market maker, and they're willing and able to make quotes for all ETFs out there, liquid or not, on exchange or even off exchange. And within that group is the lead market maker. The lead market maker is responsible for putting 2-sided quotes of the ETF at any given point of the trading day. And that is based upon the listing exchange requirements, be it the NYSE, be it CBOE, NASDAQ, wherever the product may be listed, primarily listed. Also, I'm going to talk about institutional trade desks. These are trade or resources that advisors have through their custodial platforms that can help them achieve efficient ETF trading for all size ETFs against all types of ETFs which have a lot of volume or have less volume. So let's just go to the next slide and talk about ETF liquidity. Yeah. Oh, Todd, yes.
Yeah, Matt, but as we move to the next slide here, I want to make sure we're going to bring back up to the audience. You showed 90% of the money is in ETF or is in ETFs, or 90% of the products don't show on the screen that much trading volume. But there has to be more trading volume available if investors want to come in the door, that you guys are willing to take that trade, the market makers are willing to do that. I think we'll move to the next slide, and you probably have some data to back that up.
Yeah, so good question, Todd. Ones that I get from clients from time to time, like, I really like your product, I really want to invest in it, but I only noticed that it only trades, say, 20,000 shares a day, and that doesn't seem like it's liquid. And I like to pause there and say, well, the product is actually liquid. It just doesn't have volume today. It's, the volume only shows what was traded of the ETF. It doesn't show what could have been traded of the ETF. And then hopefully this slide right here is one that can bring that thought home. I like to look at ETF liquidity with 3 levels. We can also think about ETF liquidity as an iceberg, where the tip of the iceberg is only so much above the waterline, but below it, as we know, is so much more ice that that make up that overall iceberg. And ETF liquidity is somewhat the same, where level 1 here is the on-screen liquidity. It's the current bid offer spread and the size available to trade. It's also the average daily volumes, also known as ADV, that you will see. And again, this is only what's been traded of the ETF. It's not what could have been traded of the ETF. Because underneath that level 1 is there's level 2. It's that non-display liquidity. This is where market makers are posting quotes out there, maybe a little bit wider, but for larger trades. And I like to think about this as only as an advertisement. It's saying, look, I'm willing to do a larger trade for you. Just come and let me know what you're looking to do, and I'll give you the most efficient quote that I can. And there's ways for an advisor or an investor to access that through certain trading guidance that and tips that I might have later on in this presentation. The third layer, which is the basis of ETF liquidity, is the liquidity of the underlying securities that the ETF holds. The creation and redemption is where market participants can use the underlying liquidity to create more shares of the ETF, then pushing liquidity for larger trades and the ETF in general. And I'll talk a little bit about that on the next slide too. So here, let's just put it to that thought about that iceberg into sort of the way that an investor might trade an ETF. An investor, usually when you think about an ETF, I'm going to go to my brokerage account, I'm going to go to my broker, and they're going to trade on the exchange for me. I'm going to buy and sell shares, put out a market order, which I'll tell you in a few that's not, I usually guide to saying limit orders for ETFs, for all ETFs, no matter volume, those that have volume or those that do not. And I'll give reasons why. But there's also, as an advisor who's on the major custodial platforms, even the smaller ones, they have resources for you. And, as the next build that we're going to see here shows, is that they have institutional trade desks. And these are desks that are professional traders that have, and again, we're building here, so let's go to the next build, that have direct access to the ETF market makers. And what they will do is they'll take your trade, the rolled up trade of all your client accounts, maybe it's $1 million, $2 million, $10 million, $100 million, whatever it might be. They'll take that and they'll go directly to the ETF market makers. And the ETF market makers will then, they'll go to multiple ETF market makers, and those ETF market makers will give back the most efficient price that they can trade for that size of order for a particular ETF. And we have to remember that they know, the ETF market makers know that they're in competition and they want to win that trade. They want to be part of participating in that volume. So they will look at their risk models and their books against that ETF and provide the most efficient quote that they can. And what the platform institutional trade desks do is that they will execute your order at the best quote that they get back from the market makers that they go out there and request a quote from. Now, why can the ETF market makers do this and provide efficient quotes for large sizes of ETFs? It's because of the next stage here. It's that creation redemption mechanism. Those ETF market makers, one thing I have to say is that once your trade is done from the institutional trade desk, you're done. You're executed. No more need. You're invested. You're not going to participate in the next stage here. This is where the market makers will utilize an authorized participant. Maybe they're an authorized participant themselves, but they will utilize an authorized participant. Go buy the underlying securities that the ETF has or is being required, transfer them into the custodian of that ETF, who then in return will provide ETF shares back to the authorized participant, to the ETF market makers, all the way back up this ladder here to ultimately your account and your client accounts to settle. Vice versa on a redemption. This is the same process for a redemption. Institutional trade desk to ETF market maker, authorized participant will sell the underlying or send the ETF shares to the custodian, and the ETFs custodian will send underlying securities back to the authorized participant, which will then be the ETF market makers. So next slide here. Let's put this to use or show some examples of, block trading, which I like to call it. Here's an example of our diversified municipal bond ETF, ticker is TAXF. It's a municipal bond product, as mentioned. It's managed by a long-standing team that we have here that has a research team behind it that picks, the best, most convicted line items that they think based upon the risk exposures that are out there for the muni market. The one unique thing about this product is that it can allocate between 5 and 35% of its portfolio to high yield municipal bonds, increasing the yield of the product as well as the return. And they do that based upon market dynamics and so forth in the muni market. But it's a very unique strategy because most of the ETFs that are out there in the municipal bond space either focus on IG or high yield. They don't do a mix of both high yield and IG together. But here, we have a trade, $19.5 million. We know that this was a buy because there was a creation behind it that we saw come in through our desk. The average daily volume for this product at the time in trade was only 679,000 a day. The bid offer spread is what you see here, and the price that was executed this $19.5 million trade at was within the spread of the ETF. Very, very efficient. I have a negative impact versus rival, meaning what was the quotes at the time versus where was it traded, and it was negative because it was better than the prevailing offer that was out there. So great efficient trade here. So next one I'd like to show is our American Century Focused Dynamic Growth, ticker is FDG. This was the first, or one of the first, because we launched 2 on this day, of the semi-transparent active ETFs under the Presenting Active Shares model. And this is a strategy of high convicted growth names that focus on early stage companies that have rapid growth, have the scalability to have a competitive advantage, but yet still be profitable. And we felt that it was best to put this in a semi-transparent active product. Again, these products are products that do not disclose their holdings on a daily basis, but yet still have metrics out there for the market makers to provide efficient pricing for them and accurate pricing. And so in this case, there was a buy of 7.1 million. The average daily volume was pretty decent, 1.9 million average daily volume for this product at the time. The bid offer spread was what it is out there, the prevailing one, and the price was exactly at the offer, the prevailing offer. So there was no impact to the market. Again, this is another trade that went to an institutional block desk, why it's so important that went off. And if you don't have access to an institutional block desk, your main broker dealer will have an ETF desk that can help you do this as well. Just one more
Matt,
example.
before we go to the
sure.
Yeah, I'm sorry, Matt. Before we go to the next slide here, I just want to drill this home. This is an ETF that is advertised as it's not a traditional ETF because the holdings are not disclosed on a daily basis. And anyone that goes to your website will see a big flashing, this is different than a traditional ETF.
Yeah, this disclaimer
this
language
investor bought, right, and it's just required from a regulatory perspective. This investor bought 3 times the average daily volume and executed that as if it was a regular trade, regardless of whether it was fully transparent, semi-transparent, or otherwise. That's just amazing that this trade got executed as if it was a normal ETF, because it is functioning like a normal ETF that trades intraday.
Yeah, that's right. Before these were launched, there was a lot of talk, are semi-transparent active products going to be able to be traded in the market like any other ETF? We believe that was the case. That's why we launched these products. We felt it was important to utilize some of the benefits of these products to help the overall return of the product and make sure that we were providing our investors the overall outcome that we were expected for this product. But at the end of the day, yes, they are different types of structures, but they are ETFs. They trade like any other ETF out there. There are market participants, ETF market makers, that are willing and able to provide efficient pricing for these products. We have seen good volume in our products, very good market quality, as I mentioned earlier in the webinar here, and believe that they've been working. They've been out for over two years now, going on 3. It's been very good to see, and more of these types of products are coming out from other issuers, as well as our considerations too. So next slide, just one more example here. This is one that excites me too. Because I really like to see efficient trades and large trades go off in ETFs, because I just know that they can happen. And here's another example, AHYB, our American Century Select High Yield product. This product is managed by the Nomura Corporate Research and Asset Management team. They're our sub-advisor, high yield specialist. They focus on double B and single B primarily in this product. Really, the research team really hones into what they think will be the rising stars. New product, as you can see, inception date was late last year. As most new products out there, and as you touched on, Todd, it takes some time for the overall daily volume to increase, and because they're just new products, right? And they're out there. And this product, in this case, only had 3,000 average daily volume, but yet a $13.8 million trade went off at the prevailing offer. Very, very efficient. Again, the value of using an institutional block desk to get this trade done, because it allows for competition within the ETF market makers to, sort of stand up and provide the best, most efficient price. And they're willing to do that, and they want to do that. They want to provide that efficient price. So 3 examples here of great efficient trades that I've seen in the recent past. So let's just move on to the next slide here. Some key market quality metrics that are terms that you might hear is, what's the spread of the ETF? What makes up that spread of the ETF? Well, the underlying bid offer spread of the underlying securities is the basis for the spread of the ETF. And then market makers will have to have an understanding of what their costs are to access those underlying securities. And that may be added to the overall spread of the ETF. But we have to remember, those are costs that any investor who wants to replicate that strategy will have to face anyways. So that's the basis of an ETF bid offer spread. And that's we monitor that as a capital markets group to make sure that they are within our metrics and where we think that they should be, and that's how we calculate it ourselves. So sometimes that spread is within the underlying basket. Sometimes it may be a slight wider, and that's just because of the type of market that the ETF actually represents. So next is premium and discount. Premium discount, we can look at it as 2 ways. The most common way that investors, advisors can see it and most quoted is really the end-of-day premium discount. That's where the ETF work closed for the day versus where the NAV is. And if it's above that, it's called a premium, the closing price. If it's below that, it's a discount. Various factors what cause that. Premiums discounts do not lead to, well, the ETF is trading rich or at a discount and so forth. What it's showing is what we like to call price discovery of the underlying assets that are in that ETF. And I'll go into that on the next slide in a minute. But before we move there, there's another premium discount that you can look at, and something I touched on the last slide, where there's a bid offer spread of the basket and there's bid offer spread of the ETF. And there's premiums discounts related to those 2 market metrics too. It's a little harder to see here during the intraday trading, but something that we certainly look at here in the capital markets team. So next slide. What are the things that impact spread and premium discount? It's the type of underlying securities. Investing in an ETF that invests in large cap US equity, you're going to find that the spread is very tight. That's because the underlying market is very tight. One penny spreads of the underlying securities most of the time. But as you lead into emerging markets, say high yield, commodities, spreads are wider. ETF spreads will be wider for these type of ETFs that buy these underlying markets. There's creation cost. Yes, the creation redemption is out there to provide liquidity, but there is a cost to do that. They're reasonable costs. It's just movement charges. And again, it's costs that would probably be assessed no matter if you're buying the ETF or not, because it's expensive to buy emerging market, say securities in the local market. So it's just going to be additional costs. Volume, the volume of an ETF does impact the spread. The higher the volume, the tighter the spread, but it's only because there's competition out on the open market for those spreads, and the spreads tighten up because as more liquidity comes to that ETF, the market makers need to compete by making tighter spreads if they want to participate in that volume. But again, it's just because that ETF's been out there for a long time. There's a lot of AUM, there's a lot of investors in that. There's just natural liquidity. But for those lower volume ETFs that might have wider spreads, the spreads that you see are not bad. They're just a representation of the underlying securities that are in that the ETF holds. News is another thing, company-specific news, country, regional. This is more premiums and discounts. If there's, say you're investing in a ETF that holds Japan. Well, during the US market hours, Japan's closed. So you're going to see a natural premium discount because the market participants out there that are quoting the ETF and the market in general is going to put a fair valuation to what those Japanese securities that the ETF holds, what that fair valuation is during our market hours. So therefore, it leads to a sort of a price discovery mechanism for that particular market during our trading day. And that's why I put up country, regional news, and government news. Say in an emerging market or any other market, there's some major event that happens in that particular market. You're going to see that reflected in that particular ETF that invests in that market during the US trade day. Number one thing before we move on here, market uncertainty, market volatility. We know that when market uncertainty and volatility is out there, spreads widen out. Spreads of the underlying underlying securities widen out, which will then just reflect in the spread of the ETFs. So if you're not comfortable with the spread during volatile times, put a pause, maybe wait, because it's just you're trading into a market that is generally volatile and uncertain. If you like to see tighter spreads and so forth, just wait till that volatility calms down a little bit. I mean, we're in a market right now where there's heightened volatility. You're going to see slightly wider spreads because of that. Anyways, next slide here to wrap things up. Few trading tips to think about as we close here. Trading times, when to go out there and actually put a trade in for an ETF. I like to tell clients sort of avoid the first 15 minutes of the market open, and that spreads are wider, premiums, discounts are larger. And that's only because market participants for those ETFs are trying to understand the trend of the market, understanding where things will be moving around for that particular market. Not all market participants are in the market at that time. But what I see and what we observe here on the American Central Capital Markets team is that, yes, spreads are sort of wider at the open. But after 15 minutes or so, you see those spreads start coming in and sort of settling in for the day. So think about that. I like to say generally be cautious going into the close. Market makers might widen out the spread as they think about their closing auctions and imbalances. Again, you still definitely can get efficient trades right there at the, going into the close. But if you have an opportunity to trade earlier, I would recommend that. Order types. I talked about market orders earlier. Yes, market orders, very liquid ETF. Sure, go ahead, put a market order in, but just know that at any given moment, the markets can move on you. So the price that you see might not be the price that you get. And with that limit order, it sort of allows for you to protect that price. If you like that quote that you see, you want to protect that price, put a limit order on that, maybe a penny or two above the offer, just to give it some room, and you should have a very efficient experience. I see a lot of times that when limit orders are used, it actually executes within the spread too. Don't use stop limit orders, use stop limit orders. Don't use stop orders. Stop orders only a price where things trigger an order to become a market order. And in a falling market, that trigger could happen, and then you can get executed way below the price that you think you're going. So you put a stop, put that limit on it, saying, no, no, no. Yes, trigger here, but I still want that price that I trigger at, and see what happens. And you can always adjust your orders as the market's moving around. As an advisor on those trading platforms, you should have the option to do not held orders. Talk with your institutional trading desk though, and make sure that you are utilizing the order types that best get those trades to that institutional trade desk. Not held orders are common in the larger platforms, TD Schwab, LPL, Fidelity, and so forth. But there could be some others out there that may use not held in a different way, and I highly recommend, and as in the last category here, call them, get to know them, understand the best way to get your orders to them, put your orders in their hands, because that, again, they have access directly to those market makers, and they can get you most efficient price. Leverage a block desk at a larger broker dealer if that's needed. And then speak to resources like myself and my team. We will provide guidance, talk about the same things that we talked about here. I spent a good amount of time on with clients, talking to them about these different trading tips and guidance, and I've seen great outcome from that. And it's something that they implement going forward. So certainly reach out to us. And Todd, this is where the slides end, and happy to take some questions. I know we're up to the time here, but I'll hand it back over to you.
Well, thanks, Matt. I appreciate that. And we did get a handful of questions, so we'll take a few of them. And then if anybody whose questions we didn't get to, we at CFRA or Matt and his team at American Century will follow up directly. But Matt, I wrote a piece earlier this week that talked about, it was a bit of a primer ahead of this, and I used one of American Century's international equity ETFs, the ticker is QINT, as an example of an ETF that invests in non-US stocks. You mentioned Japan, but it also invests in the United Kingdom and France and other developed markets outside the United States. That ETF typically trades at either a slight premium or a slight discount based on the close. Just want you to reiterate whether that you guys view that as to be normal practice for an international equity ETF, and how, if somebody was to put in a trade, when is the appropriate time to do that? Is it during market hours in the morning, where at least there's some of the stocks are trading underlying are open at the same time that the ETF is?
Certainly, one thing that we should keep in mind too about spreads, and when you're comparing products, be it our product versus another international ETF, is that some products are called fair valued, where their NAV is fairly valued based upon market movement in the US, and some products are not. It's just a aspect of the preference of the asset manager. So you're going to see sort of varying premiums and discounts versus those products. It doesn't mean that the premium discount is wrong or a product is bad. It just might be just the way that some of the products are accounted for from a net asset value perspective. And for our products, which are fair valued, let's call it, not fairly valued, but fair valued in the NAV, they will trade at a slight premium discounts, because within that there is still room for the price discovery of the underlying assets that the ETF holds. And so you're gonna just naturally see that. And as for your question about should investors trade in the morning when those markets are open, certainly good advice. And it's advice that I used to provide and where I used to, really sort of stress actually. And I pulled back from that. And why is that? Because I feel that the ETF market in general, and the market participants out there, and the competition related to buying and selling ETFs by those ETF market participants who each have their own fair value markets are putting quotes out there based upon what they think that fair value is over our given point in that time of day. And because of all those competition, it's driving the ETF to where the market is feeling is fair valued for that particular underlying securities within the marketplace. A little bit deeper dive right there on that, but I just think that markets are just efficient in general. And I think that trading in the morning, yes, there's more transparency because the underlying markets are open, but yet there's good transparency at the later part of our trading day because they know what's in the underlying basket. They know what their fair value of the ETF is, and you should be able to still get a very fair, efficient price for that in the later trading days.
Makes sense. So I'm going to try to group a few questions that came in together in one that will be our last question, but it'll hopefully cover a number of topics that people had in mind. So we're getting a lot of people who are saying they weren't aware that there was an institutional trading desk that was available at where they are clearing from or where they're at, and wanting to understand that. So maybe I'm going to even boil it back a little bit. If somebody wanted to buy one of American Century ETFs, and they wanted to execute more volume or more dollar volume than is showing up on the screen, they should contact their trading desk. And then what happens after that?
Sure. Well, I'd actually advise to actually contact them before you have a trade. But if it is one of those things, you want to buy one of our ETFs at that particular point in time, talk to your representative your representative at that custodian, that platform. Ask them, do I have access to that ETF or your institutional trade desk? And they will, hopefully they say yes to you. They should, and then they'll put you in touch with them. Another thing you can do is reach out to the ETF sponsor. Myself, I know how to contact those desks too. Can help guide that. But again, it's important to contact that desk because they have specific ways about how to reach out to them with your trades. And once you have an understanding of that, maybe some technology build that, that needs to take place just to make it more efficient, not meaning that the trade can't happen at that given point in time, but they can guide you and help you with that. So just make sure you reach out to them. If, today, off this call, you're saying, well, I never used the institutional trade desk, or maybe you're new to ETFs because you've used mutual funds, but looking to transfer some of your allocation to ETFs. Well, make a call to your representative and say, hey, do we have an institutional trade desk that we can use? And hopefully the answer is yes. If not, give me a call and let's talk about it. And we'll see what we can do to help you ensure that you get efficient execution with your ETF trades.
That's great because there's some amazing products. American Century has them, other firms have them, where the assets are under $100 million, but they're great products and they are unique. They offer exposure that an advisor likely wants to be able to get, either it's actively managed or it's index-based with a twist. They should be able to have access to them. It sounds like they have access to them. They just have to fully appreciate all the tools that are available to them.
That's right. Very good.
Great, Matt. So we're gonna go through the disclosures that are gonna pop up on the screen so that we make sure we get through those. As I thank you, Matt, for joining me. I thank the audience for joining. And what I will also say is that a survey is going to pop up. We'd welcome the feedback to make sure that we at CFRA are both providing the content and services to you and bring the next programming that's appropriate. So Matt, thank you for joining us and have a great rest of your day.
Thank you, Todd, and thank you for everybody that attended to have a short discussion about ETF trading here. So thank you very much.
Thanks a lot.